Good morning and welcome to this Wednesday, February 23rd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. The big thing technically yesterday was we had kick saves. A number of places will show you some charts, but at least in the short term, and this is one of the things I wrote in the daily market report to members yesterday, the close was kind of important because intraday we went down below that 4,300 on the S&P 500. Remember, we did that back on January 24th, got way down below 4,300 and came back and made a huge kick save. And I don't know, maybe a couple of weeks later, we set that right shoulder up near 4,600. This time, I wouldn't expect that we would get all the way back to 4,600. But coming back up yesterday and closing above 4,300 beat the heck out of the alternative of closing below 4,300. I think that would have triggered a lot more technical selling, and that could have been a problem. I was literally watching it into the close yesterday, and the 4,300 level was like 42.99, 43.01, 42.99.95, 4,300.12. And then right into the close, we got a couple of points higher, a couple of ticks up to the 43.04 level. So very interesting action, I would say, yesterday. But short term, we did close on the north side of 4,300. And I think that, well, I mean, we see futures up this morning. So at least it's giving the market a little bit of a lift. It'll be very interesting to see whether or not this rally has any legs. And I'll be watching to see how the market closes. I always like, we're in these kinds of areas, very important key support levels from a longer term perspective in a bear market or a potential bear market. How do we close in the afternoons? Is the market selling off late in the day or is it rallying? Yesterday, the net in the afternoon was a rally. We did come off that 42.67 low on the S&P and started to rally. So anyway, that's kind of how we're starting off the day today. And futures currently, well, at least last time I looked, Dow futures were up a couple hundred points. The S&P 500, which was flirting with that 4,300 level, getting a little bit of room, up about 30 points, and the NASDAQ up 140. And that was all about 5 or 10 minutes ago. So might be a little bit off, but that's where the market stood. So, and after holding support, that's what I would have expected. I would have expected the market to be green. Not a guarantee because we do have the VIX. We closed up near 30 yesterday. We were well into the 30s, 31 and change earlier in the session. And if we do break down at 4,300 with a VIX that's already up into the 30s, that could get ugly very quickly. So my guess is that the VIX settles down here a little bit. I don't know if we're going to go all the way back down to 20. Maybe we will. But my guess is we're going to settle down here over the next couple of days and see whether or not we can hold this 4,300. It is the worst time of the calendar month, though. So if there's one significant negative to keep in mind, we are between that 19th and 25th period, which historically has produced negative annualized returns since 1950. So anyhow, keep all that in mind. Let's go ahead and get this thing started here. I'll get your screen up and just take you over to Earnings Beats. For any of you who are new to Earnings Beats, just go over to earningsbeats.com. I always like to point everybody in this direction because we do have a free newsletter. It's completely free, no credit card required, just a name and an email address. And it'll give you a sense of what we do at Earnings Beats, some of the ways we look at the market. Comes out 3 times a week, Mondays, Wednesdays, Fridays, typically a very, very quick read. We try to make it so that literally, it's two paragraphs in a chart. So, you probably start to finish be done in about, 1 or 2 minutes. So we just try to make it very quick, simple, looking at things that are important to us, the earnings, gaps, relative strength, candlesticks, like yesterday, that tail going below 4,300, just like it did back on January 24th. Before we came back up. And anytime I talk about the tail, I'm talking about the intraday low and then the close back up above the key support level. So anyway, go over to earningsbeats.com, check that out. Moving on to the action from Tuesday after the long holiday weekend. Sometimes the Tuesday after the holiday weekend isn't very good because Mondays tend to not be very good. Well, when you don't have a Monday, Tuesdays are the first day of the week. So I have noticed, I've never done a study, haven't gone back to see what the annualized return is, but just seems like Tuesdays sometimes take over when they're the first day of the week. And yesterday, the Tuesday took over. Dow Jones Industrial Average down 482 points. So while I'm talking about, hey, this was a win for the bulls because we didn't break down, it wasn't a great day. The Dow Jones, like I said, down almost 500 points, but it was down more earlier. The S&P 500 down 44, NASDAQ down 166, almost 1.25% there. Mid caps down 36, small caps down 18. All of these percentages all above 1%. So this was not a good day. I don't mean to paint this as though it was a good day. It was a kick save. And if you're a hockey fan, it looks like puck's going to go in the net. And the last thing, the goalie kicks his leg out and barely keeps the puck from going in the net. That's kind of what happened in the market yesterday. The Bears literally had shot the puck right into the corner of the net, and the Bulls had a little kick save right at the close. Anyway, discretionary stocks were the big loser yesterday, down 3%, almost 3%. Big move down on discretionary stocks. I know furnishings were rough. Home improvement retailers, Home Depot came out with their earnings. The stock was down $30, I think. I mean, it was a really rough day for Home Depot and many of the areas within discretionary. Energy stocks also had a rough day, down 1.6%. This has been your leader, though. Did see a little crack in the foundation, though, with a slight close below the 20-day. I don't know. We'll see whether or not energy continues. I think it continues to go higher. I just don't know short term whether we're going to see it continue to go higher with a slight break of the 20-day. We'll see. Materials down about 1.4%, down over $1 there. You can see down close to support, not really breaking down yet. Communication services down another 1%. I mean, this is just been like a slow death for the XLC. Every day it seems like this is among the worst performing sectors. We've seen media agencies really tough, not doing well. Many of the internet stocks getting hit hard. Even a stock like Google that had gapped up, looked like it was breaking out on its earnings, has been down almost every day since. I think yesterday closed below 2,600 after opening with earnings over 3,000. It's just been one day after another, just seems like every day going down. Industrials also down. You can see all 5 of these that I'm showing you today were all down. All 11 sectors were down yesterday. Consumer staples were the best performer, but that was, I think that group was up maybe 1/10 or down only 1/10 of 1%. So everything was down just about everywhere you looked. So again, yes, I'm saying it was a kick save. It was bullish in the last couple of hours, but overall it was another very bearish day. Industrials down almost 1% there. Moving on to the 10-year Treasury yield, we saw the bounce. We talked about getting down to the 20-day moving average, possibly as low as 187, and then look for another move to the upside. Well, we didn't wait for that. We're bouncing. We bounced a little bit yesterday, coming off the low at the 20-day, and today we're up another 3 basis points back to 1.97%, almost 1.98%. And while we continue in this uptrend, you can see down here, financials on a relative basis continue to perform really well. They normally do that historically, but industrials, which also normally do that historically, are not. And I think part of it could be that rates are going up because of the inflationary fears, more so than they had in the past. So last year when we saw the 10-year Treasury yield going up with inflation, we saw the XLI moving higher, but I don't think it was, I don't think the market was really worried about inflation back then. I mean, if you just look at other areas of the market, I mean, gold, the way that some of the growth stocks were hit, I mean, I guess you could certainly say that the stock market was kind of following that theory. But the way I was looking at the bond market and gold, it really just isn't screaming at me inflation. Even now with the 10-year Treasury yield breaking out, I would be expecting, and I know it doesn't happen in a day or a week, but I would have thought the 10-year Treasury yield, to be quite honest, to be a lot higher than it is right now with inflation soaring. I mean, we haven't seen anything like this in 40 years. So I would think there'd be so much bailing out of the bond market. And there has been some, but again, 2% doesn't seem like 2% is really a whole lot to be, fighting inflation. But anyway, it is what it is. That's where we are right now. I do think we're probably going to go higher over the next couple of months. breaking out above 2%. Really, there was nothing major on the charts, long-term resistance to get all the way up to about 3.25. I don't think we're going there. But 2.25 wouldn't shock me. Maybe even higher than that. We'll see how things go over the next couple of months. But we're going to hear lots more about inflation, lots more about the Fed raising rates, all these wild predictions. I actually saw, I think it was Saunders from Schwab, who came out and mentioned the R word, recession, that they also think that the rate hikes and the higher crude oil prices and such could start to lead to recession down the road. And that's one thing I've been talking about. It's like, that's going to be the next theme. Once we get past the inflation and the interest rate scare, I think the next talk is going to be recession. And I kind of talked about inflation and then interest rates a year ago, that how that was going to play out. I'm telling you, next is going to be recession. When the Fed raises rates and inflation starts to come down and everyone's like, why are you raising rates? Right now, everybody's clamoring, you got to raise rates, you got to raise rates. Well, when inflation peaks, that'll go away. And especially when you see consumer confidence falling and some of the other, our economy's still okay, but you're starting to see just a couple of little signals that maybe the economy is not as strong or isn't going to be as strong as we think. And now you've got the tensions over, Russia and Ukraine. I don't think that's a huge impact on our market, but it's still in the news. It's going to affect consumer confidence, consumer sentiment. And so I still think down the road, we're going to have to deal with the R word. Whether or not we get one may not even matter. I think it's going to be close. I wouldn't be surprised to see our GDP go negative at some point later this year. With interest rates going up, crude oil prices going up, the Fed raising, however many times they decide to raise, the fears about inflation and so forth. I would not be surprised to see a slight temporary recession, but I think it's going to come down to the Fed. I think it'll come down to how many times they decide they think they need to raise rates and how much they raise them. Are they just going to go quarter in March? They're going to go half? Are they going to have a emergency rate increase before they even get to their meeting? Who knows? But I think the Fed, it's going to be in their hands whether or not we have a recession down the road. Just my opinion. All right, let's move on to a few charts I wanted to show you here in talking technically. I just wanted to bring up some kick saves. I talked about the kick saves, so I thought maybe we'd go over some of those. Just a few. S&P 500 was the big one. This is the one that I was watching. Hopefully many of you were watching. If you get that neckline break at 4,300 on the closing basis, that's not good. Well, we closed at 43.04 after moving intraday to 42.67. If we pull up this 5-minute chart, you can see after 2 o'clock, it looked like we could have had a meltdown. We didn't. We had the nice move back, got almost all the way to 43.40, and then here we come back again. Oh my gosh, we're going to have this swoosh back down. We got down to just below 42.90 in the final 5 minutes, 10 minutes, and then the rally back right at the close to get back up above that 4,300. So there's your kick save. First step in this rally is just to start printing higher highs on a daily basis. So you can see we're in this downtrend, printing lower highs, lower lows. So first thing we're going to do is hopefully early on from a bullish perspective is go up and take out yesterday's high at 43.62. So the S&P is going to have to be up 58 points to get to that point where we break out. If we can, once we get to a new high, then at least we have the makings of a short-term uptrend. Then I would just simply be watching the prior lows. And as long as we can print higher lows going forward on a daily basis, then I would say that, where everything's intact on this short-term uptrend. Once we roll over, or maybe we look at the 60-minute chart, hourly chart, you can see we've also got that 20-hour moving average coming in at 43.52. So you got 43.60 on the daily, or on that hourly. All right, I'll get it here in a second. On that 10-minute chart that we were just looking at, And you can see yesterday, there it is, that's at 43.62. So we got that intraday high, and then we've got the 20-hour EMA. So if we can take both of those out, great. Now, if you've noticed since the top, we did one time or a couple of times go above the 20, but we couldn't get through the 50. And if you notice this prior low right here, we went right through. So that's going to serve as a little bit of resistance at about 43.75. And the 50 hour is going to continue to drop. So that's going to be the second key area. If we can get through 43.62, then I think you've got the next area. It's going to be between 43.75 and that falling 50-hour SMA, which is up at 44.10 right now. So those would be the next two. And then you stretch out and you look at the daily chart. And the daily chart, you have the declining 20-day EMA at 44.59. So I'm going to say 43.62 to 44.59 is where I believe this rally will end if it gets there. Somewhere in that range is what I'd be looking for. And then the next move down, I think, is going to be a swish. And it's going to be probably pretty fast. That's the way I see it playing out. Does it mean this is the way it's going to happen? Of course not. The market can do anything at once. We could go back up and test 4,600. We could go right back up to an all-time high, and this just becomes a correction, not a bear market. I'm not trying to guarantee anything. I'm just based on my signals. I don't think that's what's going to happen. One side of me says, I hope it does, but there's another side of me that says, my gosh, we still have sentiment issues. We can't do that. We really need, the market needs this badly. I know everybody, if you're long or those that are long, don't need it in their portfolio balances. But I think the market, in order to really launch and have this secular bull market continue, I think we need to see this breakdown. I think we need to see 3,800, 3,500. I think we need to see a lot of fear in the market, unfortunately, which we're already seeing with the VIX, but we need to see it in the options world. We need those options traders to feel like there's no hope, that there's no way the market's going higher. And I think if you go through another couple months of inflation, higher interest rates, talk of recession, geopolitical concerns, oil over $100, I think you could start to get to there. All of a sudden sentiment could be a lot different in a few months than it is right now. Anyway, that's the way I see it. We'll see what happens. So this is one kick save here. I spent a little time on this one because I think this is probably the most important. I think the S&P 500 is the key benchmark to watch. But we also have the NASDAQ, which, if you notice, went right down to there. That's support. And this was the low close was actually after the 24th. We actually went down on the 20, what is that, maybe the 27th, and put in this close down around 13.3. Well, I can tell you what it was, because we're close. I don't know if we closed below it or not, but it's very close. The close was 13,352.78, and we closed yesterday at 13,381, 381 versus 352. So we did have a breakdown intraday on the NASDAQ. We came back up and we closed above it. Kick save. Next up, the XLY. The XLY was the worst performing group yesterday. The close on the 27th, 174.30. Yesterday's close, 174.75. After being as low as 172.65. Kick save. Came back, held at the close. The last one I'll show you is the technology ETF, the XLK. Now this one I think may have closed just beneath 150, 154. There's a close at 151.38. Yesterday we closed at 151.03. But considering we were at 149.38 intraday, I mean, looks to me like probably a kick save. And also, even though we are below this low close, the left side over at the beginning of October, we're not below that. So I still would be looking at this as the neckline right about there. Using these crosshairs, the inspector, that comes in right about 147.74. Go over here to this close. That closes 147.78. So that's really the key low to close. So as far as I'm concerned, we've still got a kick save. We're still fine on technology. We haven't broken down. If technology goes, consumer discretionary goes, NASDAQ goes, there's nothing holding up the S&P 500. It'll be gone. So these were all very important charts yesterday and very important last couple of hours. If you don't follow technical analysis, you might think, what the heck's the difference? You look at the S&P 500, and instead of it being, down and closing at 4304, which was down 44, who cares if it was 54 versus 44? Well, technicians care. I care. Close at 4294 would not have made me feel very good, because market makers can control, as you're getting close to the end of the day, they've got the capital to bring prices higher to a point where the market closes at over 4,300 versus 4,299 or 4,286 or whatever. Market makers, as far as I'm concerned, direct opening prices and closing prices. So that's why I'm always looking at candlestick bodies. It's because of market makers. When a stock individually breaks down intraday, that's how market makers build inventory if they need it for their institutional clients. That's why folks get stopped out and they're left at the end of the day wondering what happened. Why? Wait a second, I got stopped out down here. How'd the stock close back up above? It's market makers. They have institutional clients that want to buy shares. The best way for a market maker to get the best possible price, which is what they do for their institutional clients, they are looking to provide the best possible price they can get for their institutional clients. And guess what? That impacts all of us, because the best way they can get the best price is to trigger stops and take our shares. That's what market makers do. I mean, they're not necessarily bad guys. They're just greedy guys. And maybe that makes them bad guys and gals. But the S&P 500, this is the one we really need to continue to watch. Now, there were some breaks yesterday. Don't think that everything you saw out there was a kick save. We did have some breakdowns. So I'll just point a couple of those out real quick. First off, we got the Dow Jones small cap. Oh, no, it wasn't small cap. That's not the one I wanted to show you. I don't know why I wrote that one up here. The large cap, small cap has gotten hit so hard back in January. It's going to take a little bit to get back down to that low. But large cap on a closing basis. Now, if you're looking at intraday, you say, well, it didn't go down below that January 24th low, and that would be correct. I tend to follow closing prices, and this closing price is below this closing price. And so we have a down sloping neckline. Now, we broke below on a closing basis, but did we break the neckline? Well, based on what I looked at, I thought it was a slight break of the neckline right there. I mean, that's about as close as I can get to making sure I'm connecting those closes. And we went just a little bit below. So I have a feeling with the market rebounding, we're probably not going to get through that 20-day. I see a breakdown, false breakdown, maybe just briefly. I think we go back up one more chance on the upside before I think the market rolls back over in a big way. So, but I didn't like this chart. I was watching the large cap growth. I wanted to see if it held. We did come off the lows, just like the market, so that was good. But I do see a lower close, and I even see a slight break of that neckline. So market, maybe today we get this rally, get a little kick save, but I'll be honest, if we opened and sold off immediately, went right back down and lost the neckline, I wouldn't be shocked about that either. And I'm not trying to hedge. I mean, some might say, well, geez, you're saying it could go higher, it could go lower. Yeah, I mean, my short to intermediate term view, and when I'm saying the next couple of months, I think we go lower. That's my call. I believe we're going lower. I don't think we've seen the low. I don't think that January 24th low is the low. I think we're going lower. But in the short term, coming back up and holding those lows, I think it's very possible. Maybe we get another 20-day test before we break down below that prior low. That would not be, a completely unusual thing. However, look at the VIX. This is what drives the uncertainty in the market. The volatility index opened yesterday up near 32. We had a high of 3204. January 24th, when we hit that low, you can see the VIX was 38. By the time the VIX hit 30, from the time it went from 30 to 38, the S&P 500 went from over 4,400 to almost 4,200. That's almost 200 points or 5% on the S&P 500 in one day. When the volatility index gets up into the 30s or possibly into the 40s, we're not going to see the S&P go down by 1/3 of 1%. If it goes down, it is going to go down in a swoosh. Market makers are going to go on vacation. They're going to be nowhere to be seen in terms of providing support. And if anything, they're going to be on the short side, and there's going to be almost no one buying stocks. And that's why you take these massive hits when you get the VIX up in this area. Now, the VIX already is 32. As a bull, I am hoping, beyond hope, that we just set another low and that this is it. And now the selling is over and we're going higher. That's what I'm thinking if I'm in the bullish camp, or that's what I'm hoping. If we break down with the VIX where it is right now, just be careful. That's all I'm saying, because you saw it back in the financial crisis. You saw it with the pandemic. You saw it with the trade war in the fourth quarter of 2018. When the VIX is up into the 30s or 40s, there, it seems like, when is someone going to actually buy something? I mean, what the heck? What is going on? Just be careful. And I'll just leave it at that. A couple other charts that we'll look at real quick. How about the NASDAQ 100? With large cap growth doing poorly, you can see the NASDAQ 100, same kind of a chart as that large cap growth, because they are very similar. But we're down below the this recent low. We're down below, just below the neckline. So we got issues there. As far as our major sectors go, aggressive sectors, I showed you the XLY and the XLK still holding up. Industrials did not. Industrials went below this low. We closed at 97.39. And if you look over here, the low was 97.47. So it was just a small break below, that late September, early October. That's the left side of the neckline on the S&P 500. So we did actually break below all of these low closes going back over the course of the last 10 months. So we did technically have a breakdown, but we came off the earlier low and we got back close within 8 cents. So you can just see industrials not doing well here on a relative basis. And I showed that earlier with the TNX. It's just not doing what it normally does when interest rates are moving higher. Normally interest rates move higher because of the economy. The economy strengthening or is expected to strengthen, so rates go up, yields go up. In this case, I think if anything, maybe we're going to be looking at an economy that's deteriorating. I mean, transports right now are not doing particularly well. We've seen railroads bounce back a little bit, but overall, transports have struggled. Industrials have been struggling. This tells me that the market may be starting to fear a recession because of the Fed's talk about raising rates. That's the difference, I think, between rates going up back earlier in the year when industrials went up and rates going up now with industrials going down. I think it's the fact the market is telling us a story that's different than the media. The market is actually beginning to worry about recession. And that's why those large cap growth stocks are now starting to weaken. They didn't care about the inflation. They have pricing power. Apple can raise prices and everybody is just going to pay them. They're not worried about inflation. They're worried about recession. And that's going to be that's where after the stock market has already priced in, Wall Street's priced in the recession, then we're going to start hearing about it in the news. They're always 10 steps behind, or maybe 100 steps behind. All right. Went through a lot. I wanted to kind of drag this out a little bit though, because next up is the earnings spotlight, and we'll just combine earnings spotlight with the 3 you must see. We'll just make this like the 10 you must see, because we're going to go through some earnings reports. I wanted to get the market to open. This is the upcoming earnings chart list that we did for today. It has all the companies that reported yesterday and also the ones that reported this morning. Well, all the ones that reported yesterday after the close and the ones that reported today before the open. So if we pull this chart list up and look at it in summary form, if you put it in name order, we have these numbered. So all of them starting 0001 all the way down to 0065. These are in order of market cap of companies that reported yesterday after the close with a market cap above 1 billion. The 1001 to 1046 are in market cap order for all the companies that reported this morning with the market cap over 1 billion. So that's what these chart lists are that we do every day for our members. Now the market just opened. It's 30 seconds past the market open. I'm going to refresh. Actually, what I'm going to do is I'm going to put this in percentage change order. And actually, let's look at, this was yesterday's, but I want to make sure I got the latest here for today. All right, so here are your winners. This is the beauty of having this chart list in your account. It's 9:31, and I can tell you how every company is doing that reported earnings since yesterday's close. Vertiv Holdings, and if it's close, this is going to be a higher market cap if it's a lower number. So 1001 is going to be the largest market cap. What was it, 1060 or whatever I said was the smallest market cap. So VRT, Vertiv Holdings, is 1009. It's a pretty heavy market cap company, down 38% at the open. Rackspace Technology, 27%. You know, sometimes what you get are these big hollow candles. When stocks gap down crazy, everybody wants to sell, and market makers are on the long side. And so sometimes you can look at these and potentially get a rally back on these companies after you get some early selling. So what I do sometimes is just write them down. So I'm just writing down on a separate piece of paper right now. VRT, 38%. RXT, or I could do a screenshot. Sometimes I'll just do the screenshot. RXT, 28%. MNDY, 23%, 23.5. CSGP, I'm going to show you some of these charts in just a second. 18%. And then RSKD, Riskified. And that's down 11. All right, so let's pull these charts up. Actually, before I do that, let's go up here and get a few of these that are up high. Do this, you know, every day. Just a little test, if you will, and see how these companies do the balance of the day after they get these big moves. And maybe even they might set a low in the first half hour or so to really draw a lot of folks in. Market makers get a big long position on the ones that are selling off. And then we see the big, potentially sometimes we see a big recovery. But just, you know, maybe do a paper test and just look and see, okay, well, what if I had gotten in at the open? What if I waited until 10 a.m. and got in on some of these? And, you know, not big positions. You know, I wouldn't be trying to, you know, pay off the mortgage on these trades. Just, you know, see how they perform over the course of the day, and not just one day, but do it over several days and start to get a feel for some of these companies that are taking a big hit. Anyway, Overstock was up 29%. Skin 23, CDNS 11. That's Cadence Design. That's got a pretty nice long-term track record. Stock's been really beaten up. Scooter 18. NU, it's 10%, and then we'll do PLAB 7.5. All right, so let's look at these charts, and then we'll wrap this thing up. So Overstock, well, it got up as high as 48.42 very early. I mean, we're only 3.5, 4 minutes into the day. We got up to 48.42. We're already at 46.13. I mean, it's already dropped $2.29 from the high. But this is why sometimes you'll see, and I'm not guaranteeing anything. This thing could turn around and be at $55, $60 later today. Who knows? But just do what I said. Do, you know, watch them on paper. You're going to see a lot of companies that gap up and have these big gap ups and then print black filled candles and sometimes even red candles. They'll go all the way back down and go negative. But sometimes you get the big gap up. It's like a relief, you know, dead cat bounce, because you're getting this huge drop ahead of earnings. Then the earnings come out, probably not very good, or even if they are, you get a gap up and then a sell off. So right now we're at 46.13, all the way back to 48.50. Okay, that was quick. So this, you can see the volatility is going to be, make sure you're comfortable with that. All right, SKINs continue to go higher. This one right now is up 31%. So That was 23. Now it's 31. Overstock's about where it was, right? What was that? 48, which was 32%. So just jotting those down. So 3 minutes in, 32. CDNS, there's another one that gapped up to 150.23. It's at 146 right now. So now it's up 8%. It was 11 when we looked at it earlier. NU, which was up 10, now it's up 4%. So there's one opened up at 965. Now it's back down to 915. So now instead of being up 10%, it's up 4%. And this we're talking about in the course of 2 minutes. So you can see the volatility is crazy. Now there's a gap up. Now I'll tell you, this one would bother me about being short on the open. Why? Because it opened above the prior highs. I mean, we're getting a breakout here on the open. Market makers know where resistance is. We opened above it. That's a little bit of a hint that we are probably going to get a breakout. So instead of shorting, what I would do is actually, if it pulled back, if I found a key support level, 19 or maybe gap support or even the 20-day EMA, if it came back down that quickly to those areas, you might consider a small position on the long side. And then as it starts to rally, maybe start adding and make it a more reasonable position. Because I like it when a stock breaks out on the open. I think that's pretty good. All right, so let's take a look at the bad ones. These are the ones that gapped down that we looked at just a second ago. VRT was down 38%. Well, it's down 39% now. But look at how far it went down. I mean, it got down to 1106. Now it's 1180. So sometimes you get these big drops. Everybody's selling at the open. Massive volume. Look at the volume already. Almost 4 million shares. It's only had in the last 10 months, it's only had 2 days over 6 million shares. And we're already at 4 million in the first 6 minutes, 7 minutes. So going to be a crazy day there. And, playing earnings, whether you're trading before earnings or right after earnings, it's extremely risky. So if you're somebody sitting back, trying to, just get a little income here or there and you're in retirement, this is probably not for you. But as a trader and somebody who's willing to take risks and sometimes be on the side of the market maker, which usually isn't a bad thing. Look at this one, CSGP. Opened at 49.42. Now it's 53.41. You'd be up 10% if you got in. If you had an order in at the open, you'd be up almost 10% right now in how much time? 9:37, 7 minutes. How about MNDY? This one gapped down, went up about $5 initially and came back down. But you can see on almost every one of these, you can see the volatility. RXT, we did RXT. How about CSG? Wait a second, did I get out of order? I did that one, didn't I? Yeah, I did that one. RSKD, let's do that. This will be the last one. I've gone a little bit over, but I wanted to show you this after the market opened. So today it opened at 603, got as low as 589, now it's 617. And now this one is interesting because it gaps down, but it looks to me like it may have held support. The open was 601. Today's 603 was the open. So it actually gapped down, but it opened just above that low, went down 589 low, 587 low, went down basically and tested that prior low. This could rally back up pretty nicely. Now, I don't know that I personally wouldn't do it at 619 because if it gets back down to the low, you're down 5% just to get back down to 589. So that would be, pretty volatile stock, but just keep those in mind when they gap down. Now it's at 629. I mean, they move really fast. One click to another, 619 to 629. Let's try it again, see if it's 639. No, still 629. Anyway, just wanted to point that out. That's how you can use these chart lists. I think these chart lists are so cool. And I never get any feedback, rarely. I think we were in a webinar the other day and somebody typed in a question or comment and they said they love these upcoming earnings chart lists. I think it was the first time I heard anybody say anything. I mean, just to be able to look back and to see every company that just reported on one chart list. And I'm trying to get stock charts to give us, because they can do pre-market. I'd love to be able to do a chart list and have pre-market prices on it. So we know where everything is in our chart list right before the market opens. That would be a really cool feature. And I've told Stock Charts I'll promote it for them. I'll have it front and center at earnings beats, because it kind of combines what they do and what we do. But anyhow, yeah, let us know. I'd love to hear from somebody that uses this, and how you've been able to use it, and has it helped you, and that sort of thing. And if you do want to comment, you can just send it out into support@earningsbeats.com. So let's just get a quick update on the market, see if the rally is holding. I would suspect it is. Yeah, NASDAQ up 140, up 1%. S&P 43.36. Remember, 43.62 is what we're looking for. So let's go to that S&P last chart I'll show you here. Let's look at the intraday. And you can see there's that yesterday high. Morning strength. You always have to be a little leery of morning strength. Yes, it looks like maybe this is an area where we'll start to uptrend, but sometimes you'll see that morning head fake and right back down again. So again, I'm not trying to hedge my bets. I'm just telling you, VIX is 30. We could go anywhere. That's why I don't like to trade in this kind of an environment, because I don't feel confident. I could get into the spider right here thinking, okay, we bottomed, and be at a new low in 15 minutes, 5 minutes for that matter. But, we could have a couple of big red bars, and next thing you know, we're right back down. I mean, look, yesterday in the morning, it looked like we were pretty good first 45 minutes. And then 30 minutes later, we were back at the low. And so that's what you have to be aware of in this kind of environment. I think the overall downtrend for this cyclical bear market remains in play. And that means any kind of a bounce increases the risk being long or adding longs. I would be very careful personally about buying stocks in a short-term rally, because we could roll back over at any time. And if we do break down, and you're in longs, make sure you have your stops in play, or that you got some kind of insurance, put insurance, you're selling calls. And the thing is, selling calls will save you a little bit, but if the market takes a big drop, even selling covered calls is not going to save you a lot. It's just going to save you a little bit. So that's it. I know I ran over, but just take all of those last 10 earnings charts or whatever is your 3 you must see. Let's go ahead and wrap this up. I will be back tomorrow over at Stock Charts TV. So if you want to see the next episode of Trading Places live at 9 a.m. tomorrow, just go over to Stock Charts TV. It'll be a recorded version, but depending on how the action goes today, if it's really interesting, I may hold off until tomorrow morning to do my recording before, maybe like 7 or 7:30 a.m. to see what futures are doing before I actually do the recording. But we'll see. Still, the recording itself will be done and be available at 9 a.m. tomorrow morning. Everybody take care and happy trading. Good luck out there and be careful. Happy trading.